Now onto some common sense on how to hopefully avoid an IRS audit. Craig Bolanos, the CEO and founder of Wealth Management Group, is here with that. Craig, let's start with legal ways to lower a tax bill.
Angela, tax procrastinators everywhere are shaking in their boots. There's not that much time left to file our taxes for 2023. And typically, Angela, once the calendar year ends, there's not a lot that we can do to lower last year's income, but there are a couple key strategies that people should consider, especially as we come to the deadline. So part number one, just save to your individual retirement accounts. Remember, you might be eligible to make a pre-tax IRA deposit for 2023, all the way up until April 15th of this year, 2024. And this is especially key if you are getting close to being phased out or cliff tested from certain deductions and credits. And if you're self-employed, don't overlook the fact that contributions to a SEP IRA, better yet, a solo 1K, might be up your alley. And what about if you're married? What if you have that special someone in your life, your husband, your wife? Consider contributing to a spousal IRA. Now, IRA contributions, right, come from the requirement of having earned income, but there's a provision. If you are married, you have a partner, and you have a non-working spouse, yes, you can put money in under spousal IRA provisions. That's going to help you as well. Third on my list, boost your health savings. What am I talking about here? If you have a qualifying high deductible health plan, and a lot of plans are high deductible these days, you could qualify to fund a health savings account. And HSA is triple tax preference. That's tax deductible contributions, tax deferred growth, and tax-free distributions. Those are three things we can all do to lower our income prior to filing our return for 2023.
Craig, we are all ears. What else can you tell us about IRS red flags?
Well, Angela, you're right. You and I talked about some common red flags. Well, let's go through them. The first is round numbers. If you're going to claim a tax break, it's important to use accurate numbers, and those aren't necessarily round numbers. Saying a sole proprietor spent $5,000 for advertising and $3,000 for legal expenses just might seem a little too convenient, don't you think? Use accuracy, not round numbers. Red flag number two, missing income. Forgetting to attach a 1099, forgetting to include a K-1, that's going to cause the IRS matching program to kick back your return. So when you're doing your tax prep, develop a full and complete checklist so you don't make a material omission. And then red flag number three would be tax deductions that are just excessive relative to your income. I'm not suggesting that someone who makes $80,000 a year is fibbing if they give $40,000 a year to charity. After all, some people are generous, but if your deductions fall well outside the boundaries of what would be usual and customary for your income level, don't be surprised that you're going to be asked to defend that deduction. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. We exist to help people get retired and stay retired, and a core component of that is proactive tax strategy. Check out our website at investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.